Welcome to This Explainer. Today, we're diving into how central banks manage wildly complex economic crises. And they do it using a tool that's basically a flight simulator, but for an entire nation. Think about it for a second. When a pilot is learning to navigate a severe turbulent storm, they don't do it for the very first time in a real plane filled with real passengers, right? They use a simulator. Well, we are going to look at how economists use that exact same concept to navigate the most severe economic storms imaginable.
When an unprecedented shock, like, say, the COVID-19 pandemic, hits an emerging market like Indonesia, what do policymakers actually do? They desperately need a safe, virtual environment to figure out exactly which levers to pull without crashing the real system. You just can't experiment with interest rates and banking regulations in the real world and cross your fingers hoping for the best. The stakes are simply way too high. We're talking about millions of jobs and the entire financial stability of a country on the line.
So to pull this off, economists use something called a DSGE model. Now, I know, that stands for Dynamic Stochastic General Equilibrium, which is a highly technical, fancy term, but at its core, it's just an incredibly advanced mathematical simulator. It lets us literally replay an economy's crash, track all the cascading data, and test out different financial rescue strategies. It mathematically maps out exactly how households, banks, and governments interact. This means researchers can introduce a major shock, like a global pandemic, and watch exactly how the virtual economy reacts in real time.
Here is our flight plan for this explainer. First, we'll cover the macroeconomic flight simulator, then diagnosing the COVID crash, tracing shocks and fluctuations, testing the policy mix, the LTV policy paradox, and finally, the optimal crisis playbook. Section 1. Diagnosing the COVID crash, framing the economic mystery.
Let's set the scene here. Indonesia faced a brutal economic drop during the pandemic, specifically between 2019 and 2022. But to solve the mystery of what exactly drove that crash, our simulator has to evaluate three main suspects. Did the economy crash because people just stopped buying things? Because factories couldn't actually make things? Or was it because banks completely stopped lending? To figure out the right policy response, we first have to deeply understand the nature of the shock. Was it a demand problem, a supply problem, or a financial plumbing problem? Let's see what the data actually tells us. Section 2, Tracing Shocks and Fluctuations, Assigning Blame Using Variance Decomposition.
Using the model's incredibly detailed data, we can literally assign blame for the massive fluctuations in Indonesia's GDP output growth. And this is where it gets super interesting. A massive 30% of that GDP drop was blamed on technology shocks. Now, in this specific context, that doesn't mean broken computers. It means crippled supply chains and the massive sudden shift to remote work. It represents the physical and structural ability of the economy to produce. Alongside this, 25% of the drop was due to cost-push shocks. So together, these supply-side issues absolutely dominated the economic contraction. They vastly outweighed changes in consumer preference or just pure financial shocks. Meanwhile, the model shows us something a bit different for inflation. It wasn't driven directly by technology, but rather by cost-push shocks, which accounted for a huge 30% of the inflation volatility. This directly reflects the skyrocketing logistical costs of producing and shipping goods during lockdowns. So think about it. Not only was the economy shrinking because it couldn't physically operate, but the cost of the few goods that actually were being produced was exploding due to supply chain nightmares.
Section 3, Testing the Policy Mix, Finding the Right Cure. Knowing that supply chain issues and soaring production costs were the real culprits behind the crash, central bank researchers had to test different policy cures inside the simulator. The model stacked up standard monetary policy against combinations with macroprudential tools, basically to see how different banking regulations would interact with changing interest rates. They looked at a baseline monetary policy, let's call that MP, and combined it with tools like CAR, which dictates how much capital banks are legally required to hold, and LTV, or loan-to-value, which strictly limits how much everyday consumers can borrow against an asset, like a house. Normally, central banks would just hit the easy button on monetary policy to help out households. But during a wildly complex crisis, is that enough? This unique, supply-driven disaster required a much more nuanced approach to credit. If you just lower interest rates, but banks are absolutely terrified to lend, or consumers are boxed in by other regulations, that cheap money never actually flows through the economy. The central bank desperately needed to find the perfect mix of policies. Section 4. The LTV policy paradox, when standard tools backfire. This right here is where the macroeconomic flight simulator absolutely earns its keep, because it reveals a massive, totally unexpected twist in the data regarding those loan-to-value regulations. The crucial, crazy point is that adding LTV limits, which is usually a highly trusted stabilizing force in economics, actually made the economic fallout 15% worse than if they had just used baseline monetary policy alone. When researchers measure welfare loss, they're essentially measuring the real economic pain felt by everyday people through lost output and inflation. By strictly regulating consumer borrowing through LTV during this highly specific crisis, the policy backfired spectacularly.
And the data brilliantly illustrates exactly why this happened. Because the crisis was primarily a technology and supply shock, aggressively targeting consumer credit demand with those LTV caps actually amplify the economic pain instead of fixing the root problem. Think of it like this. The economy is practically choking because businesses simply cannot produce goods. If your policy response restricts everyday consumers from accessing credit to buy the few goods that are available, you are effectively strangling the economy from both ends. You're aggressively punishing demand when supply is actually the root issue. Section 5. The Optimal Crisis Playbook. Lessons from the Flight Simulator.
So, if demand-side regulations are actively hurting the economy during this specific type of crash, what did the virtual Indonesian economy prove actually works? The data shows a clear, undisputed winner: easing supply-side regulations on banks so they can eagerly inject capital into struggling businesses while completely avoiding strict demand-side caps on consumers. Easing capital adequacy ratios, which essentially allows banks to dip into their rainy-day capital buffers to lend to businesses, was welfare improving. It demonstrably helped the economy. Conversely, messing with loan-to-value limits was welfare reducing.
Let's pull this all together into the ultimate strategy. The optimal playbook for a central bank facing this kind of shock is incredibly clear. First, you absolutely have to recognize that a pandemic is a supply-side crisis at its core. Second, maintain an accommodative monetary policy. Keep those interest rates low. Third, let banks lend more freely to businesses by easing capital requirements. And finally, whatever you do, keep your hands off countercyclical demand tools like LTV. Give the banks the flexibility they need to support the businesses that make the economy run.
Which leaves us with a pretty critical question to ponder regarding your own domestic economy. In the face of a complex supply chain crisis, are your policymakers relying on outdated rules, or are they pulling the right levers? Because as this incredible model of the Indonesian economy proves, using the wrong tool at the wrong time doesn't just fail to fix the problem, it can actually make the crash a whole lot worse. Thank you so much for joining me on this deep dive into the macroeconomic flight simulator. Keep questioning the data and keep learning.